Hey there, everyone. Welcome to another edition of the Market Misbehavior podcast. I'm your host, Dave Keller. Such a pleasure to bring some of these great conversations with top analysts, strategists, and traders and share their perspectives on the current markets, their lessons learned over their years in the markets, and which areas they find are most important to focus on as we navigate here Q4 of 2024. Today, I'm sitting down with Mike Singleton of Invictus Research. Mike's a fantastic strategist. He's one of those guys that's able to combine the broad economic data, the realities of the economic data that for many feels kind of obscure and difficult to understand. Mike does a great job of taking, at times, complex theories and ideas and boiling them down to very straightforward takeaways, and really helps me, and I hope you, make sense of the current economic and market environment. He also combines some technical analysis tools as well, which is what I really like about Mike and his work. In our conversation, which I'm about to share with you, we talk about GDP growth, and why the economic data may be, or why the economy may be stronger than some of the data recently may imply. Talk about jobs, and particularly why the initial jobless claims number that so many of us focus on as it comes out every time may not be the best way of actually assessing that particular area of the economy. Really enjoyed his comments about small business optimism versus small caps. I've talked about small cap outperformance and the possibilities there with a number of my recent guests, but I really liked Mike's sort of unique take looking at small business optimism relative to the upside potential for small caps. Finally, he's done some great work backtesting on basic momentum models, looking at moving averages, looking at overbought, oversold conditions, and I think some of the evidence he's going to share with you backs up hopefully many of the things that we talk about at Market Misbehavior. So enjoy my recent conversation with Mike Singleton of Invictus Research. All right, we're sitting down with Mike Singleton of Invictus Research. Mike, good to see you again. We've chatted over time, but not in a couple months, I feel like. How's your year going? Where's your head at these days?
Well, thanks for having me, Dave. It's a pleasure to be here. Congratulations on your new venture. Best of luck. I know it'll be very successful. Everything's good. Everything's good at Invictus Research. It's been a good year for the stock market. We've pretty much been bullish the entire time in 2024, and we continue to be bullish now. So that's kind of where we stand.
When you and I have spoken, it's been a pretty constructive discussion, I think, of market conditions, and overall, as you said, it's played out pretty well to the upside. I know you brought some charts with you, some ideas to talk through, just to sort of make sense of what we're seeing here. Let me bring up your first chart, and we'll get started here. And again, start us with the big picture of where we're at on sort of the economic side, right? We have GDP to focus on first.
Yes. So what I would say is, I think when you talk with Wall Street strategists and economists, the phrase that you hear most right now is growth slowdown. Things are slowing. That's a pretty consensus view, I think, even among policymakers. Hence, you have the Federal Reserve cutting interest rates. Pretty much no matter who you talk to, the phrase growth slowdown, it's almost unanimous. And funny enough, at Invictus, we really don't see that when we look at broad-based measures of economic growth. So the slide up right now is the Atlanta Fed's real GDP nowcast for Q3. And you can see this most recent reading is for 3.2%. That is an extraordinarily high number. At Invictus, we think long-term potential for the US is around 1%, maybe 1.5%. So we're seeing growth that's 2 or 3 times potential. It's 130 basis points or so above the blue chip economist consensus. Pretty much by all measures, this is a very, very hot number. Now, I think that there are plenty of fair criticisms that you could make about GDP. It's a lagging indicator. There's some accounting noise. We can deal with some of those, one of which we can deal with the accounting noise by stripping away some of the noisier subcomponents of GDP, like changes in private inventories and net exports and government investments, and just look at real final sales to private domestic purchasers, which is on the next slide. And you can see the Atlanta Fed is nice enough to sort of provide a breakdown of what's driving GDP. And if you just looked at consumer spending, non-residential fixed investment, and residential investment together, that would be real final sales to private domestic purchasers. It's running at about 2.7%. Very, very strong, right? That's, if you're calling for a growth slowdown and you have real GDP running at 2.7%, or core real GDP running at 2.7%, you've got some explaining to do. That doesn't make a whole lot of sense. And we could look at a bunch of other measures of broad-based economic growth as well. The weekly economic index, which comes out every week, also looks quite hot, also running above potential. The real growth situation looks very good, and that tends to have the closest correlation with the performance of stocks over time.
Interesting. So, I guess if the question is the economy slowing, it would seem to me not that much, right? I mean, we're remaining fairly resilient at this point. Is that fair to say?
Right. There have been parts of the economy that have been a little bit softer, and some of those have been slowing for a very long time. So to just acknowledge that they're slowing now in 2024 is crazy, right? Housing's peak was in 2020. We had been covering that, for the last several years. I don't think that's the story for 2024, that total home sales are down 40% or so, or that the manufacturing sector is showing negative growth if you look at some of the PMI data. That's been the case for a long time. And in fact, we think most of those sectors that have been weak, like housing and manufacturing, are probably bottoming and about to recover. So among other things, what that implies is if the services economy continues to run hot, and at the same time housing and manufacturing is starting to accelerate again, we could even see acceleration in the broadest measures of economic growth from here. And it sounds crazy to think that we could see 3% plus GDP growth on any sort of sustained basis. But look, manufacturing growth has basically been negative for the last, it depends on what measure you look at, but year and a half, right? Total home sales are down 40%. There's an enormous amount of slack in housing and the goods economy that really doesn't require any kind of new investment to backfill. And with lower interest rates, if they materialize, which is a big if, it's very reasonable to expect acceleration in those sectors.
You had mentioned, and obviously, I want to talk. I know we can talk about jobs here in a moment because the Fed speakers have talked about how we're sort of navigating or rotating from inflation being the area of focus now that it's sort of allegedly coming down to manageable levels. Now we focus on jobs and make sure that side of the equation is strong. When you think about rates that have come down, right, the 10-year yield from 5% down to 3.75-ish, and now just starting to pop back higher. What do interest rates mean for us kind of going forward? Where's the impact, and what's your outlook in rates in particular?
It's a good question. And so first I would say on an economic basis, lower interest rates like we've seen tend to be stimulative, especially this sounds silly maybe, but lower interest rates is stimulative of interest rate sensitive parts of the economy. So the most obvious of which is housing, right?
Right.
Sometimes you have to say the obvious things because they're so obvious that people gloss over them and just forget about them. But the average 30-year fixed mortgage rate is down something like 175 basis points since last October. That's a big deal, right? On the margins, that improves affordability, considerably, right? And if you look at the cadence of mortgage rates versus total home sales, mortgage rates lead total home sales by 3 months with something like an 80% correlation. It's very, very close. So when you see 170 basis points worth of declines in the 30-year fixed rate mortgage, you should expect total home sales, transactions closed, to improve in the coming months. And with more home sales comes more purchases in durable goods, right? Home furnishings, furniture, people making new additions to their house, buying cars, refrigerators, washing machines. And that's what drives the manufacturing cycle and also generally drives the economic cycle, right? Services is kind of the steadiest part of the economy. So if services is holding steady while manufacturing improves, generally broad measures of economic growth will improve as well. So, that could be what we're looking at over the next couple of quarters.
And we've seen certainly home builders, home improvement stores not looking too bad from a technical perspective. These are some of the most, probably stronger, more emerging parts of the market here recently. Let's talk a little bit about jobs because, again, the Fed has sort of, talked about rotating their attention away from inflation, which seems, sort of generally in manageable levels. We've got CPI here this week, PPI as well. Talk to us about jobs and how you're seeing the trends evolve over time here.
One more quick note on interest rates, because I forgot to mention the implications for stocks. When you see a 2 sigma decline over 3 months in the 10-year yield, generally that's very good for stocks. So you tend to see above average returns for the S&P 500 in a statistically significant way. So just to connect that to the financial markets, because you can't trade GDP, you have to know how it affects the financial markets that you're investing in. Lower rates faster tends to be pretty good for stocks. Back to your question on jobs, there's obviously some consternation about the labor market, or else the Fed would not be cutting rates. It's true that various measures of labor market activity have slowed, and the unemployment rate did increase from 3.4% to, I think it was 4.3%. It's back down to 4.1%. At Invictus, we were never terribly concerned about the labor market. And one reason is because one of the timeliest measures of layoffs is called initial jobless claims. And it's the number of people in the states that apply for unemployment insurance every week. So it's a great, reliable, hard data point that's a proxy for layoffs. And it just was never very high. And you can see from this slide, or if you just go to Fred, you really don't get recessions unless unemployment claims are increasing kind of quickly. And that's just not what we're seeing right now. And it's kind of the opposite, in fact. If you look at initial jobless claims as a percent of the labor force, which is really the right way to do it because the labor force today is considerably larger than when this time series began in 1967.
Right.
As a percent of the labor force, claims are actually at a secular low, right? You can see going all the way back to the 1960s, they've never been this low. So this most recent print this morning was for 258,000. How does that compare to the first month of historical recessions? By our math, we'd have to see around 450,000 layoffs to be consistent with month one of historical recessions, and we're just not there. We're really not even close.
That's a really interesting way, Mike, to kind of standardize this data series in a way I've not seen used very often. That's well done. Your next chart, similar. We're talking about layoffs.
Right. So the strength of initial claims has garnered some skepticism in the economist, macroeconomic strategist community. Maybe the benefits paid out aren't as high as they used to be, and so people are getting fired, but they're not filing for claims. I don't think anyone's ever turned down free money, but maybe that's true. One of the reasons we don't think it's true at Invictus is when you look at other measures of layoffs, and there's a lot of different government data sets on this, all of them look pretty low to us. So another important one is called non-farm layoffs and discharges from the JOLTS report that we get every month. And you can see layoffs are low just from looking at this graph. They're actually 11% below pre-COVID levels. So that's the period of time between 2010 and 2019, as we're calling it. So, again, it's just not consistent with historical recessions. So to get really, really worried about the labor market, or more to the point, to be bearishly positioned on stocks or risk assets because of your view of the labor market just doesn't really make sense to us right now.
Interesting. These are two really interesting slides. And again, I feel like so often we're caught up in sort of like the headline number with non-farm payrolls, with jobless claims, and actually using this to think more about the historical reference. Really well illustrated, Mike. I appreciate that. Talk to us about small business optimism. These next couple slides, I think, deal with this and small caps as well. How does that fit into the overall picture we're painting?
So this is the NFIB Small Business Optimism Index. What does it represent? Well, I think you can think of it as representing growth in economic activity for small businesses, or you could just think of it as a proxy for growth in earnings for small businesses. Why does this matter? Well, small businesses account for about half of payrolls in the US, half of GDP, 2/3 of net new job additions. Small businesses are really, really important. And on Wall Street, really no one talks about them because you can't invest in the mom and pop shop down the street. You can invest in stocks, and stocks tend to be big businesses. But what's going on in small businesses really matters. So what are we seeing when we look at this chart? First things first, small businesses are not feeling terrific, right? Historically, this is like a 15th percentile reading. If you look at the average reading through recessions, it's about 92. So you could make the case that sentiment among small business owners is recessionary right now. That said, it's improving in rate of change terms. I don't think you need to be a CMT necessarily to see that this looks like a pretty clear bottoming pattern. We saw a big decline. We've seen consolidation. Momentum appears to be reversing. And a couple of months ago, we saw a multi-year high in small business sentiment. And we're down a little bit, but we saw a month-over-month improvement in September. In any case, we think that this probably bottomed. And 2 points that I want to make about this. This is another huge sector of the economy with a lot of slack, right? If we're seeing 2.5%, 3% real GDP growth with small businesses saying that they're experiencing recessionary business conditions, imagine when small business conditions improve, right? I think it's not hard to imagine that broader measures of economic growth improve. So you've got three big sectors of the economy that are very soft right now and could easily improve in the coming quarters. You've got housing, manufacturing, and small business. The second reason that I think that this is an interesting chart is if you flip to the next slide, you can see that the ratio of the Russell 2000 to the S&P 500, or the ratio of small caps to large caps, has kind of tracked this ratio pretty closely for the last 10 years or so. And so if we're right in our assertion that the NFIB Small Business Optimism Index has bottomed and will improve, then it might follow from that the ratio of small caps to large caps has bottomed and will improve. And there's other reasons to think that as well. I don't have good slides for it, but for one, when economic growth is accelerating in rate of change terms, generally small caps, as the more cyclical exposure of the two, tend to outperform.
Sure.
Not always, but most of the time, more than 50% of the time. And then second, we saw a big momentum thrust, if you remember, in July in small caps. Yeah. We saw, I don't know, it was like a 4 sigma move in 10 days or something like that. And historically, that tends to presage really strong performance from small caps. So you've got all of these factors that are sort of the stars aligning for small cap outperformance. And depending on what your technical indicators are that you're looking at, I don't know whether a bottom in small caps has been confirmed, quote unquote, but we're looking for confirmation at Invictus. That's how I might say it.
It's such an interesting space, and you're right. I think the challenge with small caps in 2024, at least at times, right? You've had such a dominance of the mega cap names, right? The sort of Magnificent Seven stocks, and so the benchmarks have done well despite the fact that small caps have not been as strong, which is a bit counterintuitive because I was trained in a bull market phase. Small over large is and I even have a chart from years ago that I haven't changed yet called risk on versus risk off, and the relative performance of small caps has a place of honor on that chart. Having said that, I think you're right. I mean, it's in the process of emerging. It's still, I feel like, a little bit more to prove, but arguably, talk about a change of character would be a period where small caps do start to outperform. I think that's sort of a theme that a lot of people are kind of underinvested in. It strikes me, Mike, as you're showing these first sets of charts. We talked about GDP and GDP growth. We talked about jobs. We've now talked about small business optimism. I have to ask, because we're now, in the meat of a very contested election season, how do you think about the outcome of the presidential election and what that does to the probabilities of some of these themes playing out in certain ways? Is that a factor in your thinking now, or is it more of a let's wait and see what happens and then we figure out how to project potential growth from here? What do elections mean relative to these trends in the economic data we've seen so far?
It's probably a little bit more of a wait and see, I would say. I guess I would say that, historically, I think this is well known, but historically, Democrats, Republicans doesn't tend to affect the performance of the stock market all that much. I will say stocks tend to like certainty and dislike uncertainty. President Trump has been president for 4 years. Vice President Harris, the amount of work that she's done in the Biden administration is not totally clear. And I think on the one hand, that represents her bona fides. And on the other hand, she doesn't want to claim responsibility for everything. So there's more certainty around President Trump because he was president for 4 years and he's very vocal about claiming what he's responsible for. And there's less certainty around Vice President Harris. So I think you can make the case that will be, a Harris victory might be a little bit less positive for stocks. I would also make the case that when you look at the small business sentiment data, it is extremely clear that small business owners tend to lean Republican and favor Republican presidential candidates because their sentiment always improves when there's a Republican in office. And so if your expectation, there could be a reflexive improvement in small business activity if President Trump is elected, which could also be reflected in increased employment in small businesses, increased investment, and ultimately increased economic growth. It's a little speculative, but I think it's not an unreasonable case to be made.
Yeah, an emerging theme to be sure. And I very much agree with your idea that generally speaking, it's a bit of a wait and see. We'll see. In some ways, we have a known commodity, but unknown commodity with at least one of the candidates for sure. Let's continue on here. Your next set of slides really talks, I think, getting into some of the technical configurations. I'm really interested to see how that relates to what we've talked about so far. I know you've been pretty constructive and rightly so on the market environment. Talk to us about the trends as you see them here in October of 2024.
So I would say bullish, but not like outrageously bullish tactically, and over a longer term horizon, I would say pretty bullish, right? Economic conditions are, pretty much as supportive as they are ever going to be. We're not early cycle, right? Like, when is the best time to buy stocks? When growth is about to go from -5% to +5%. And we're not there. We're at like a late cycle reflation, you might say, or sort of the sixth or seventh inning of a bull market. That said, forward returns can still be very good. So I think it would be silly to not be bullish here, but I don't want to overstate it.
Mm-hmm.
Now, the slide that we have here right now is maybe a bigger picture discussion point about how to use technical indicators, or maybe rather how we think about them at Invictus. So when we talk about technical analysis, we tend to talk about two things a lot more than everything else: trend and momentum. Mm-hmm. And there's different ways of defining trend and momentum. A lot of times it doesn't matter all that much. Like, does it matter if you're using RSI or MACD or stochastics? Or in our work, it usually doesn't. And if you just look at them side by side, a lot of times if you match the time horizons, they're very similar. But this is a back test that shows the performance of the S&P 500, which just represents stocks more broadly, against various trend and momentum regimes. So we're using the 200-day moving average to define the trend. If the S&P 500 is above the 200-day, that's an uptrend. If it's below the 200-day, that's a downtrend. And we're using 10-day RSI momentum to define oversold and overbought, right? And so this maybe is obvious or not obvious, I don't know. But buying the dips and uptrends, which is RSI below 30, while the S&P is above the 200-day, so that's the third section there. Average returns are extremely good. So, over every time horizon, 1 week, 1 month, 3 months, 6 months, 12 months. And we've got the average returns there, 1.1%, 2.1%. It's kind of hard to put those in context. Like, what does that mean? So below that, we have the T-stat, which indicates the degree of statistical significance. If it's above 0, that means the average return is above average. And if it's above 2, that means that it's highly reliable. It's statistically significant, so to speak. And you can see that over every time horizon, oversold in an uptrend is a good time to buy, right? It's a good risk-adjusted return. Now, that doesn't mean that, there was one oversold in an uptrend right before the stock market crashed in 2007. It doesn't mean that every single time is a good buying opportunity. It just means on average, you're improving your probability of good returns or above average returns over a 1 week through 12-month time horizon. So, that's just a good framework to keep in the back of your mind. But the summary of it would be, you want to be buying the dips and uptrends, right? That's how you earn above average returns in stocks over time. So what's the other regime where you get really reliably different returns? It's when you get overbought conditions in downtrends. So the exact opposite, right? Yeah. When RSI goes above 70 and the stock market is below its 200-day moving average, you actually earn negative returns on average on a 1 week, 1 month, and 3 month forward basis. So if you do a backtest on the S&P 500, it is generally hard to get anything that will give you negative returns, right? Because the S&P 500 goes up over time, right? So it's hard to find any strategy that earns you negative returns. It's almost as hard as finding like real alpha. But funny enough, you actually earn negative returns on average when you buy stocks when they're overbought in downtrends. You do not want to be adding to strength in downtrends. That's the worst thing you can do. And if you have an appetite for selling short, that's when you should be looking to sell short. And just as a testament to how hard it is to sell short, even though you do earn negative returns on average and the T-stats are close to -2, it's only over a 1 month basis that they're actually statistically significant.
You're fighting centuries of market history when you go short, unfortunately, right?
Right. So, I mean, if you're running if you're running with a lot of gross exposure, you just want your longs to outperform your shorts. So maybe that's a different story. But if you're going net short, you have to be really, really high conviction that you think something is going to happen.
Right. Interesting. I love this. And to be honest with you, that third line down, talking about, buying the dips. I mean, many institutions, if not most that I've been connected with, try to design quantitative models to capture that particular, theme, which has been, fairly consistent, right? Buying short-term weakness within long-term strength. Your next slide talks particularly about momentum thrust, which I think would be really interesting to my audience. Talk us through your findings here.
So we've seen a number of momentum thrust in different asset classes over the last couple of quarters. If you recall, there was a big momentum thrust in small cap stocks in July, I think. And when I say momentum thrust, I really mean like a 2 sigma move or larger within 10 days. So that's how I'm defining it within the context of this conversation.
Yeah.
We've also seen one in China. Obviously, that's been getting a lot of coverage recently. We've seen it in base metals like copper. And I think it's good to have an understanding of what these things mean before they happen. So this is another timeless slide, I think, and we're using the S&P 500 as an example here. Mm-hmm. The long story short is that momentum thrusts, whether positive or negative, tend to very reliably presage good returns, right? If you see a big momentum thrust, either way, up or down, it tends to be sort of a buying opportunity. And you can see the different T-stats and the win rates and the average returns here. And on balance, they're positive, and a lot of times they're really positive. So, you see what you see in China right now, you should be thinking, I want to start buying dips. That's a buying opportunity. Now I'll caveat this by saying it's the most reliable in a downtrend. So we talked about not wanting to buy oversold conditions. This is really, really interesting. Positive and negative momentum thrusts are most reliable as indicators of forward returns when the S&P is already in a downtrend, right? So they're good signs of bottoming.
Right.
When you see it happen and the S&P or whatever, stocks, copper, small caps are above their 200-day moving average, and that is what we saw in small caps in July, it still tends to presage above average returns, but it's not always statistically significant. Right, you can see on the left, upper left quadrant there, the T-stats are all they're all under 2.
Yeah.
Now they're above average, so it's definitely not a short sign. And if you had to take it as indicative of something, it is more bullish than bearish, but it's not like drop everything and start buying now. So again, the reason that we bring this up and we go over stuff like this with clients is because when something happens, like is happening or has happened with China, sometimes it's not super helpful to get that information after it happens and it's up 30% or whatever in 2 days. You kind of want to know as it's happening. And so just the principle to keep in the back of your mind is when you see 2 sigma or greater momentum thrusts, you really want to keep an eye out for buying opportunities. And if you're in a downtrend, historically, that's a very good sign that you've bottomed. And China was in a downtrend, right? Like unlike small cap stocks, which were in an uptrend.
For sure. And it's so interesting. I think that, I think a lot of people struggle with when something has been sort of a sleepy market, sleepy chart, and then all of a sudden aggressively moves. There's this FOMO, there's this fear that you missed out on the whole thing. And I think what you're showing is that often leads to better movements afterwards, right? If you can recognize those moves as they take off. We have to wrap it up here, Mike. But I'd love to just ask one final question. I mean, given all these conditions, given your sense of I think economic data that's not as maybe discouraging as some might have feared. Where do you see opportunities now between year end and beyond? Like where are you looking for areas of potential growth given this backdrop?
So 2 areas that we really like at Invictus are regional banks and biotechnology stocks.
Okay.
And as always, there are really 2 reasons. The first is that economic conditions are supportive, so that immediately gets us interested. And I'll use the regional banking example real quick because it's not something I've talked about yet today. The yield curve has been steepening, right? And we can go into the reasons for that. In our view, the yield curve is likely to steepen for a while. And historically, that's very good for regional banks. It's one of the highest signal indicators about performance for regional banks. And the reason for that, again, maybe it's obvious, but I don't hear everyone discussing it all the time, is that regional banks are spread lenders. So they lend long at something like the 10-year, and they borrow short at something like Fed funds or the 1 month, 3 month, whatever. Mm-hmm. So when the yield curve is steepening, they make more money on their loans. And when the economy is accelerating, which it is, they're making more loans. So you have more loans and more money per loan, which generally means faster EPS growth. So it's a very supportive economic backdrop for regional banks. And economic conditions aside, when you look at the technical setups for biotech and regional banks, in my mind, they look great, right? They look like they're carving out big 18-month bases or so. They've broken out above support. They're sort of dipping back down now, but they haven't broken down. They're just retesting that support. In our view, the next move from here is probably a fairly sharp move higher. And even if it's not, even if we're wrong about this, and there's, of course we could be wrong, your risk is very well defined. So you maybe you might lose 3 or 4% or something, but if you're right, you can make a lot more than that.
Interesting charts. And I love you're finishing on a technical note, which I so appreciate, Mike. And you're right. These charts are showing the technical concept of polarity, which is where resistance becomes support, right? An existing level becomes kind of a pivot point and then becomes support after the breakout. And these look a lot to me like the buy on the dips kind of charts we just talked about a couple of slides ago as being kind of an interesting area. This really interesting take care, Mike, as always. I can't thank you enough for coming on the show, sharing some insights. I hope we can do this again.
Yeah, of course. It was my pleasure, Dave. Thank you for having me as always.
Awesome. Thanks, Mike, for coming on. Hope you enjoyed the conversation with Mike Singleton. And again, I think his comments at the end about momentum models, just, thinking about very simple relationships between moving averages, RSI as a measure of momentum, and price action, forward-looking price performance, and just using that as a foundation for thinking about which areas of the market could present some upward opportunities, which technical configurations have tended to be the most profitable going forward. I think that was really well done and well presented. I forgot to ask Mike and apologize to him about where people can find more information about him and his work. He mentioned that they just came out with a new mobile app driven by AI, and the way he was describing it sounds really interesting. I'm excited to dig into it. You can check it out at invictus.ai. Check that out on the App Store or whatever your device you're using. And also, he's at Invictus Macro on Twitter or X. For Market Misbehavior, I'm Dave Keller. Have a great one, and remember, it's always a good time to own good charts. Take care.